Folks, we have an alarming indicator right now on the S&P 500. A key indicator is flashing red right now, and we have to talk about it because this is not good. Now, this doesn't mean that the market is headed for a crash or for major pullback. It's not necessarily that, but I'm not going to be sitting here and hiding information that I think is important to you because I am bullish on this market. It's important to understand low probability, high consequence events and take that into consideration, not just ignore that because it goes against your thesis. Now, on this channel, we have done, I think, phenomenally with the past 18 months. With the past 18 months, we've covered 9 stocks on this channel. We've called early SMCI, NVIDIA, ANET, a bunch of other stocks, 9 stocks, 9 out of 9. Everything is green, 130% in 18 months. My own portfolio with Tesla, Palantir, and the S&P 500 has done 160% in that time frame. So the last 18 months were very good to us as a community, and we thank the market for that. However, there's data that shows that right now, us being at 27.5 price to earnings on the S&P 500 is a dangerous territory. This is the highest P ratio we have had on this index in the past 20 years. If you're looking at a P on the S&P 500 and you measure the returns for the following 3 years, the interesting point about this, that if you're below 10, below 15, you're almost guaranteed to make money in the next 3 years. But if you start investing in the S&P 500 when the PE is between 27 and 30, which is where we are right now, you have a 95% chance of not making money for 3 years on that investment. On top of it, you have to understand that if you look at the S&P 500, the run that it had, it comes with a price. Right now, we have gotten to the position where we have the S&P 500 trading at double the P ratio than the small caps of the Russell 2000. While the Russell 2000, which is the small caps, is trading at about 14 PE, the S&P 500 is literally double. On top of it, I want you to pay attention to what's going on with gold prices. You see, gold prices have a very strong correlation with pullbacks, market crashes, and corrections. Whenever gold prices spike, usually we have a correction or a strong pullback or even a crash in the stock market. We are up 33% since October of 2023, not even a year, and gold prices have added 33%. That spike cannot be ignored and just waved away as some anomaly. No, this matters, and this shows you that there's a lot of positions being taken prepping for a possible crash or correction. The stock market does not exist without a correction. A correction and a bull run is like day and night. The moon and the sun, one goes up, the other one goes down. They coexist. The problem is we haven't seen the moon in 18 months. In the past 18 months, the S&P 500 is up 40%. The Nasdaq is up, 70%. We have been going up non-stop without a single proper correction. We had a couple of minor corrections, mini corrections, but we haven't seen a 5% proper pullback ever since the end of 2022. So a year and a half without a single correction. And that goes against everything we know about the S&P 500. Statistics and history show us that the S&P 500 pulls back 5% 3 times per year. We are now 18 months, a year and a half without a single 5% pullback. On top of it, a 10% pullback happens once per year. Again, we're now a year and a half into this, no 10% pullback. And every 3 years, we have a 15% correction. Again, that obviously hasn't happened yet. So if we are looking at this as a rubber band that's being stretched, and this rubber band is being stretched and stretched and stretched, the more we stretch the rubber band and the more we avoid a correction, the harsher and the more painful that correction is going to happen when it's time. Now, I don't know if it happens today, tomorrow, in 6 months, in a year. I don't know. Neither do you. But we have to prepare for this and acknowledge that this is a possibility. And we can't just ignore it and write it off and say, well, it's not going to happen. The market is great. Even if you have a bullish stance on this market, which I do have, the smart, prudent investor prepares for anything, including when they have indicators flashing red right in front of them. Now, I accept the fact, and I think you should also, that we cannot predict with accuracy what happens in the future. We don't have a crystal ball. We don't have a time-traveling DeLorean. We don't know. We don't know all the variables. We don't know half the stuff that's coming down the pipeline for this world in 2024 and 2025. Look at the past 3 months, the stuff that happened, right? We can't ignore low probability, high consequence events like a potential major correction on the stock market. We just can't. So as a smart investor, what you want to do is prepare for all scenarios. Obviously, you're not going to be able to cover your ASP 100% of the time for every single possible occurrences. That's not possible. But you try to defend yourself the best you can, even if you're a bull in this market. And it works the other way too. For example, at the end of 2022, I've made a prediction that 2023 is going to be a bad year for the stock market. But I still continued investing because I said to myself, I don't know what's going to happen. The only thing I can do is keep dollar cost averaging into these stocks I like and just continue plowing ahead, not paying attention to the market and the prices, anything. Just pay attention to the companies. If the companies remain good, you keep investing. If the fundamentals change, you don't invest. And we ended up doing 123% on all 9 companies. And it works in either direction. That point, I was bearish and the market went bullish, but because I did the right thing, I made money. Now, maybe what's going to happen is that we're bullish and the market ends up slapping us and showing us a bearish position in which, again, we're going to lose our pants if we don't prepare accordingly. Now, there's 2 ways in which this market can play out. Option number 1, in my opinion, is that the S&P 500 has just gone too hot, too quick. And certain other asset classes, such as the small cap stocks, have been lagging behind. And now that rotation is basically going to be very painful for anybody who's deep into tech. But eventually, that isn't a market-breaking rotation. That's a healthy bull market cycle. The other scenario is that the entire market is going to fall to the toilet. And what happened in the stock market over the past 30 days shows us that we may be here in option 1, not in the bad option 2, which means it's just a rotation. Look, the S&P 500 spent the last month in limbo, pretty much being flat. At the same time, the IWM index, the Russell 2000, the small caps, it has done 10% in a month. The reason that this is happening right now is very simple. You see, when the Fed started raising rates back in November of 2021, from that point on until the end of the rate hiking cycle, which was December of 2022, the IWM, the small caps, lost 27% of that value. It is still down after a recent correction, which we just mentioned, but it is still down today 10% below the initial value it had in November of 2021. So the IWM has never recovered from this interest rate cycle, even after that latest 10% spike. So it's still heavily down in 3 years? On top of it, unlike the inflated P ratio on the S&P 500, which is nearing 30, you see the IWM is trading at 14. It's half of the P of the S&P 500 and also a 10-year low. And that is very unusual because the normal situation is a 98% compatibility between the P ratios on both these indices. So basically, they should be identical. And right now, that compatibility is 50%. It's half. And that's weird because the entire market is expecting 3 rate cuts this year. If we are looking at 3 rate cuts this year, what's going to happen is that DCF valuation of small companies are going to take the valuations upwards. When interest rates drops, valuations of smaller companies with more upside in the future rises more rapidly than normal established companies. Now, on top of it, you have to understand that the IWM, the Russell 2000, it's plagued with a lot of companies that have a lot of debt. They're really leveraged. How much they're leveraged? Well, if the average EBITDA to net debt ratio on the S&P 500 is 1.6. The net debt to EBITDA on the Russell 2000 is 3. It's double than the S&P 500. So it is 2 times more leveraged than the S&P 500. Especially if you look at the floating rates, which are about 10% on the S&P 500. Mostly the S&P 500 is 90% fixed rates, so completely agnostic to Fed policies. But because floating rates are cheaper, at least when you take the loan, the floating rate dominates the IWM. 50% of the IWM loans are at a floating rate versus a 10% on the S&P 500. So basically, That creates the perfect storm. Companies that will benefit from an interest reduction much more than anything else in this market, especially when the IWM is very different than the S&P 500 in the revenue source. You see, the S&P 500 is now comprised of companies that pretty much make their money anywhere. There's 65% US and basically 35% rest of the world. The IWM, the small caps, 90% of their revenue comes from the US. If we're talking about a Fed rate cut, the impact on the US market is going to be much more significant than the global impact. On top of it, we have statistics that show us that the first rate cut of the Fed leads to a 12-month bullish cycle on small caps of about 26.6%. Again, none of these things are certain, but if we get a rate cut, then these sort of companies, the small caps, the IWM, the Russell 2000, is in the great setup versus the rest of the market. And it is currently trading at half the price. And in my view, this is an arbitrage opportunity. Look, people right now, at least vis-a-vis the small caps, are pricing in recession at a high degree and no rate cuts at a high degree. While at the same time, we know a few things. We know, number one, the Fed said literally they're going to cut rates this year. Number two, the Fed CME Watch Tool prices in 100% certainty for at least one rate cut in 2024. We know also on top of it that the economy hasn't broken yet, but it's starting to shake. And that shakiness is where exactly you want to do this before you have to cut rates in a dying economy. The setup is there for the Fed to pull the trigger. I don't think they're going to do it in July, but September seems like the proper time. Now, if you look at the other element here, a recession, obviously a recession can happen at any point and it might catch you blindsided, who knows. But looking at the data right now, we're looking at 4% unemployment, 2.8% GDP growth, a 3% inflation, and if you look at core, then 2.2%, and we have oil below $80 per barrel. So while a recession is possible, it seems like the setup right now isn't really screaming out recession, recession. On top of it, we have no IPO activity in the market that shows us some sort of a market exuberance. And the consumer spending right now is basically at the same levels it was pre-COVID. So it's not really dropping like people are saying on TV and other places. So consumer spending is fine. There's no crazy IPO activity. The market is pretty much neutral. And we're really just in the beginning phases of a huge AI bull cycle. If you look at ChatGPT and you look at the birth date, right, of the ChatGPT euphoria, basically we're looking at November of 2021, right? So we're pretty much 3 years into the ChatGPT bull cycle. If you look at a similar event that happened in 1994, which is the release of Netscape, right? Netscape was released in 1994, and it pretty much was okay. It was good until 1997. But from 1997 to 1999 was the big spike. So year 4 and 5 is where you saw the spike. We're currently in year 3 of this whole ChatGPT thing. When you have a 10% 6 months on the S&P 500, that's not very usual. That's kind of abnormal. Whenever that happens, the next 6 months, 80% of the time are positive. Now, here's my 2 cents about it. So the S&P 500 at 27, 28 PE is quite expensive. And if you're buying stocks today, it's kind of hard to make money with a 28 PE S&P 500, at least in the short term. On the other hand, the IWM stocks, the Russell 2000 small caps, are basically trading at half the price, while being set up for the perfect storm, which is a reductions in rate in a good economy, which should send all these companies into the stratosphere and the stock market will act accordingly. And that's all fine and dandy, but guess what? Ain't nobody in history ever saw a market crash coming and just said, hey, look, a market crash. We got to prepare. Market crashes happen when people don't expect them, hitting them in the face. There's always a possibility that we are in front of a market crash event or at least a major correction, especially with all these flashing indicators flashing red on the S&P 500. You can't just ignore it because you're bullish on this market. You have to take precautionary measures, such as selling a third of your biggest winners. If you are up by a lot on certain positions because you've been investing for the past 2 years, you've made a lot of money, take a third off the top and put it on the sideline. Why? Because if the market drops and corrects, then you saved a third of your cash from this mayhem. But if the market keeps flying up, you are still 70% invested and get to enjoy the most of it. And obviously the other thing you should do is just keep dollar cost averaging. If you just dollar cost average slowly into great companies, into the index, it's gonna fix itself. Whether we are going into a bull market, which is great, or we hit it into the toilet, a DCA approach over the next 5 years is going to be profitable and it's going to make you a lot of money. Just buying every month slowly is going to work in the recession, in the market crash, or in the crazy bull run. All of these events are fixed and not requiring timing if you just slowly dollar cost average. And that's all I got for you guys. I'll see you next one. Peace.